would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome to it, folks. You've made it to the end of another week. I hope it's gone well for everyone. We've got some interesting data today. We're going to share that with you and do a little bit of dancing around it and see if we can't pick out a deeper meaning or maybe come up with some good things that might help us make better decisions in the wide, wonderful world of real estate. As I mentioned before, we're going to start seeing an interesting uptick in the number of interviews that get put onto the show. I want to thank all the people who have just completely blown away all the preset times I had set aside to do interviews. I think I'm now booked up for quite a while, so we should have some interesting stuff on tap for us in the coming weeks. So stay tuned for that. I think that's going to be an exciting addition to the show. Of course, the best way to reach out to the show is through the website at www.therebelbroker.com. From there, you can click on contacts in the menu bar, send along any ideas, suggestions, observations that you might have, or you could click that big red button at the tippy top of the page titled Take the Survey to Support the Show. You'd be doing two fabulous things by doing that. One, you'd be helping to support the show. It's a great way for the show to get good advertising going on and get the show on a paying basis. All you got to do is click that button, provide the same email address both times you're asked, and then answer a handful of demographic questions, and you're all done. You've done me a great favor. Thank you very much. And in return, each month we do a drawing for a $50 Amazon gift card, and the only way you can get into that drawing is by doing that little survey thing. So there you go. A thank you from me to you. We've already given out, $450, $500 doing it this way. So congrats to all the folks who've already won, and good luck to those of you who haven't yet. Okay, where else do we want to go today? Where should we start? So much interesting stuff. I think what we'll do, just as a little teaser for after the mid-show break, we're going to talk later about how inflation affects the housing market. I get this question from time to time. So we'll sort of run down a quick list, and I'll have an article that you can check out if you want to get a little bit more of a detailed discussion about the subject over at Home Union, so you can count on that after the break. But first, let's go ahead and hit some of the interesting news tidbits that have come out over the last day or so. Number one on my list is simply going to be because it's a yay me sort of article. Freddie Mac mortgage rates increased for the first time in weeks, but could drop again next week. So this is exactly what I was talking to you about yesterday. On the heels of the Fed doing what the Fed does, there's an uncertainty factor, right? In general, people just don't know, well, what's going to happen next? Now, the 30-year fixed rate mortgage did not go up much. It went up a very small amount, only 2 basis points. In other words, 0.02%. Okay? But it went up. And of course it went up right after the Fed did its thing. And it wouldn't surprise me if this could stretch out to being a thing for as much as a week. So don't panic if it continues to go up today and Monday and Tuesday and Wednesday. I honestly believe, and again, this is just me throwing it out there. Don't kill me if it doesn't. But if I were in the position you're in, if you're someone who's looking to lock in a loan, you're about to get into an escrow, I wouldn't. I would give it at least a week to see if it comes back down, because the bottom line is 10-year treasuries have gone down as well. So the smart move for you would be to get yourself into a routine of checking what 10-year treasuries are doing. And if suddenly they jump, but they haven't, yesterday and the day before they were down. So absolutely, I think you can go in with some pretty strong confidence believing that interest rates are going to go right back down a little bit. So I thought I'd just share that one with everyone. And again, interest rates are all still very good, still under 4%. I'm not seeing any of them over 4%. So carry on. Nothing to see here. Next, I want to talk a little bit about home builder confidence, and just what's going on. I have gotten to the point now where I am almost considering not looking at the home builder confidence number at all, because all we should really care about, I don't care what builders think, couldn't care less what builders think, unless historical data reveals to me that, hey, you know what? When I hear what they think, it helps me get a better grip on what they're going to do. Well, as we've discovered here on this show, if you were making your investment strategies or letting home builder confidence numbers influence your strategies, you would have been wrong every time. Even when confidence has been super high since the downturn, we haven't seen the actions in the marketplace that reflect that confidence. I find this ridiculously confusing, understandable, but also frustrating. No, home builders do not want to talk down the business they are in. It's like asking real estate agents, "Hey, how is real estate good?" Yeah, everybody better jump in right away, right? That's gonna be what the tendency is. You'll of course sometimes get folks who'll say things aren't going great, but by and large, you want to prop up the industry that you're involved with. The National Association of Home Builders reported the housing markets index was at 67 in June, down from 69 in May. Any number above 50 indicates that home builders view sales conditions as good. So there's that. But what's also interesting is that we are simply, and here's the thing. This is another thing that frustrates me. A lot of times builders will refer to the problem being the not enough workers, right? Not enough construction guys to come out and do the work. And that is absolute crap. I up until today, I really didn't have an article to point to back that up. It was me talking to contractors. It was me talking to other folks sort of anecdotally. But I've always thought that was baloney. The bottom line is when we were at our peak, when things were nuts, that would have been a valid time to complain about not enough construction guys. But the good folks over at Housing Market have written an article titled "Shortage of Construction Workers Overblown," and I think that I'm happy as a clam to hear that they're putting that out there. And here's a quote from their article: "Currently, there are 5.9 construction workers for each single-family and multifamily housing unit that breaks ground, which is above levels seen during the boom in the past decade." See, now that's the point. If we go based on what the available number of construction folks is, they've got more available to them now than they had when they were building a ton more. So, and here's the other thing: nobody, it doesn't even make sense from a fundamental standpoint. Nobody starts the process of building new homes asking the question, can we hire enough construction workers? It just doesn't happen, folks. The first questions that get asked are, where can we build where we will make money? Can we buy the land? What will it take? What regulations do we have to comply with? Do we want to go with existing architectural drawings for homes, floor plans we've already used, or do we want to develop a new one and then hire architects and those kinds of wonderful things? So none of the questions that get asked when builders are talking about building a home, none of them are asking, oh, well, man, you know what? We really shouldn't do this project because there aren't enough construction workers. Baloney. It's always been a baloney excuse, and it's just good to hear someone else saying it. There's some other interesting data in this article. Of course, as always, it will be included in the show notes for today's show that would probably be worth your time to check out if you're so inclined. Quote, April's new home sales figures shined a light on a long-growing problem in the housing market. which won't surprise you at all, home builders are not breaking ground on the kind of houses that will alleviate supply-side pressure. Surprise. Last month, the median new home price was $309,200, down 4% from the same period last year. And we talked about that. So instead of listening to the words from builders, we're going to build more inexpensive homes, etc. Let's look at just the actions. Let's stop taking these jokers at their word, because it seems like whenever we do, things don't match up. So here's a great opportunity to just go with some numbers. Now, that decline, I think, is a good indicator. It could indicate a shift in focus to more entry-level homes, but that's going to have to be a much bigger shift in order for that to make any difference. The article points out, I think very interestingly, during the housing boom in the middle of the last decade, new home prices were just 6% higher than existing home prices, right? And that's an important distinction, right? You're paying a 6% premium for a new home versus an existing home, right? For comparables. In April, new home prices were 26% higher than the median existing home price. Or excuse me, not comparable prices in that last bit of data. That's simply above the median. So in other words, we've often talked about where home prices need to be, and we've talked about how high above the average price in a marketplace builders are building. And that's what this reflects. This reflects the idea that it's a full 26% higher on new home construction than median homes are in that same area. And remember what median means. Median means not the average. The median is the home price that sits right in the middle of all homes. So if there's 100 homes, it's that 50th home where there's 49 homes above it and 49 homes below it. Right? Or 50 homes above and 50 homes. It's right in the middle. The average price might not actually be right there at that middle point, right? So anyway. According to the National Association of Realtors, a spread of $64,400 between new and existing median prices is too much for most buyers to overcome, even with interest rates hovering near 4%. Since 2011, only 67% of housing starts have been single-family homes, compared to 80% during the previous 20 years. So just everything is screwed up. We're not focusing on single-family residential homes. When we are focusing on single-family residential homes, the prices are too high. Now, I'm going to suggest that if you want to get deeper into this data, there's an opportunity for you to download the full report from Home Union. And of course, there will, as always, be a link to that story. All right, folks, we're going to go ahead and take a quick break here for a second. But when we come back, we're going to talk about how inflation affects the housing industry. So don't go away. We'll be right back. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right. Aside from hosting this show, I am also the owner broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. We're going to jump in and talk a little bit about how inflation affects the housing market. And again, this is an article from Home Union. And as always, of course, there will be a link to it in the show notes for today's show. I think inflation is something that's important to have your head wrapped around. The probability of us having to wrestle with huge inflation is really inevitable, or at least given what we currently face, pretty much a foregone conclusion at some point, right? It's going to happen. So what is inflation? Inflation is In this case, I think that the top thing that you can point to as a reason to expect inflation is printing more money, which we've done tons of, right? We've been living in an inflationary cycle for a really long time, as we've printed, trillions of dollars. And what that does, it's an invisible tax. We've talked about this on the show before, but it's been a while. So just sort of recapping, if you have $1 in your pocket, and today you can walk to the store and you can trade that $1 for a loaf of bread, and then you go and live in a cave for a year. And during that year, the government prints up a ton of money. So it creates more dollar bills floating around, which means each individual dollar bill is worth less than it was before that money was printed. You come out of your cave after a year where all kinds of money has been printed, and now you can only buy half a loaf of bread for that same dollar. That's inflation. It's an invisible tax. It's a way for the system to diminish the value of what you're carrying that affects everything. There's other types of inflation. You can talk about inflational forces relating to specific markets, like when you want to talk about supply and demand, how prices will inflate given a low supply and a high demand. So there's that. But on an economic level, on a governmental level, the thing you feel the most that hits you is that phenomenon, that printing money phenomenon. Now, why is this dynamic also particularly interesting to anyone who's an investor? Well, because as an investor, part of your goal is to make your money work for you. Now, if you have your money working for you at a rate that is only meeting inflation, then you're making $0, right? You're just keeping up with inflation. If you have an investment and it only returns 2% and inflation is 2%, you're not making any money, right? Because don't think of your money as the end goal, the end game. It's not. You don't want money. You want what you can get for money. So it's a thing that we all decided has value and we'll all accept. But the problem is the amount of it you have to trade for stuff fluctuates based on inflation. So you as an investor need to first understand what you think the inflation rate is going to be. And then you understand the real inflation rate, because remember, the inflation as it gets reported by the government now does not include food or fuel. So if you're not including the increased cost for food and fuel, you're not really getting a handle on how much you need to earn on your money at a minimum just to break even. So what you need to do is, above whatever the inflation rate's likely to be, you then need to have an interest rate on top of that you want to make. So that's that should be the same equation that banks are going through, which frequently gets bizarrely tweaked by government-related stuff. But we don't need to get into that, because the core of what we're focusing on now is just your perspective on how these things will affect you when they happen. So let's go ahead and talk about it. Number one, it increases the cost of home construction at every level. Why? Because remember, just like we made that argument that your loaf of bread is going to cost more, so is that 1 linear foot of wood of boards to build the home, the electrical wire, the lighting, concrete, everything that you use to build a home is affected by the cost of inflation, by the rate of inflation. And oftentimes, and what's really nuts is also the labor costs can go up with inflation, but normally don't, right? The amount of money you make tends to lag way behind inflation. It's not like when inflation happens, you automatically get a raise, right? If you work for a corporation. Now, hopefully every year you're getting raises that are at least inflation plus something, or else it's not really a raise. If inflation is 2%, you get a 2% raise at the end of the year, you're breaking even. You're able to spend exactly the same way you were able to spend the year before and get the same amount of stuff, right? So it's really just about the stuff that needs to play a part in actually getting a home built. So that's an increase cost to you, right? When the cost of building a home goes up, that gets passed on to you as the buyer or the investor if you're buying new construction. So that ends up resulting in rising home prices as well. Not just because of the building costs, They put a greater financial burden on home builders, which is absolutely true. They have little recourse, but to then make up for it by passing that on to you. This isn't the only reason inflation causes home prices to rise. When the central bank increases the amount of money in circulation, a primary cause of inflation, house prices automatically increase. So it's kind of a double whammy. It's likely to have more than just the direct relationship effect than you would expect from that particular scenario. Next, decline in financed home purchases. Another effect inflation has on the housing market, and I'm quoting now, involves borrowed money. When inflation rises, causing money to become more expensive to borrow, people don't borrow as much of it. They may not even borrow any at all. This results in a chain reaction of fewer financed home purchases, which may flatten economic growth. Now, what's also interesting is if we fold this idea into the way the markets are going right now, imagine the double whammy of that, where not only now has inflation gotten all these prices higher and things are costing more money, but now we've got a scenario where economic growth tends to stutter or stall because fewer people are borrowing. It can be the kind of thing that freezes the motion of an economy so that all we're left with really is more opportunities to fall than to rise. And we all experienced that. We had something similar to that happen when the downturn occurred in the mid-2000s, to the 2007, 2008. Now, so then the question becomes, well, how do you deal with that? What do you do when inflationary things are happening? Well, one of the things you can do, because it does tend to be a hedge against inflation, is to buy real estate. And I realize, and I'd want you to research this for yourself. Just because I say it, don't believe it. Remember, I'm a real estate broker, so I also have a vested interest in robust real estate activity. I'd like to think that for those of you who've been listening to this for a while, you know that's not the game I play. But the reasons why are pretty self-evident to anyone who is an investor during the downturn. Now, some people really got pinged when the downturn occurred, particularly folks who were maybe more leveraged. But for those of you who were renting, there's actually a great article up on Bigger Pockets that I think came out yesterday or maybe even today, talking about how folks made it through in terms of being investors. And they were making a comparison between how single-family residential investors had it much tougher than multifamily unit investors. And that's a nice argument to have. But in reality, in my local marketplace, if you owned a home that you rented, you did not suffer in the downturn. More people needed to rent. Suddenly there were no homes available. Prices went up. So even in situations where things are going bad, and whenever things are going bad, even in a situation where inflation is happening, you start to see segments of the population that need to go back to renting rather than owning. They may jump into selling to get themselves out of a situation. So the real estate option becomes something that you can use as a hedge against inflation to defend against it. So depending on where you think inflation is going to go, how much money we're going to print. And remember how we've handled debt problems in the past as a nation. We've printed money, trillions of dollars of the stuff. Whether you want to talk about Obama or Bush, it doesn't matter. This is not a political thing. If you simply say presidential term X and presidential term Y, meaning the last two presidential folks, they printed up tons and tons of money. You can argue about who printed up more, and that's fine. But the bottom line is they both printed up a ton of money, which acted as an inflationary thing, which made the money you had in your pocket worth less with every dollar that they printed. Sadly, this seems to be the response of government to these kinds of economic issues. So now, kind of sit back. For those of you who are new to the show today, let me suggest you roll back a few days. Go back maybe to Tuesday or Wednesday last week and listen and catch up on the shows. Given the debt overview that we've laid out in terms of personal debt that's being accrued, crazy things going on with loans, including 120% loans where you're rolling mortgages and student loans together. The debt portfolio of more and more individuals is not a good thing. And all of that indicates that if one of those things takes a tumble, if we see something completely fall out and all of these industries are just completely disrupted, the likelihood that the government will jump in and print money to deal with it has been proven in the past to be what they do. I would love to say, no, they've learned their lesson and they won't do it. But the bottom line is all the things that caused the problems last time are being done again under different names with slightly different means, but achieving the same ends. So understanding what inflation does and being ready to deal with it, making investments that make sense, I think is key. It definitely changes my glance. I know that I am now looking far more into multifamily investing than single family. I've had a thing for single family investments. I guess multifamily, and these are stupid reasons. I'm going to say it right up front. The reasons I tend to buy single family residential homes for investments or make those my focus are not smart investment reasons. For me, it's I like houses. I like architecture, and I like coming up with a cool way to redo them, to change them, to make them more marketable. And that works for a flipper, right? But if you're a buy and hold guy like I want to be, a multifamily thing is more about utility. It's more the utility of the real estate versus I'm a fan of this architecture, so that's why I want to own it. I often find myself being drawn to properties that don't represent a great investment because they're so outdated, like really old homes. I was looking at something last weekend that was built in 1906, which is super rare in my marketplace. I know those of you on the East Coast who listen are going, come on, I got houses in my neighborhood that are 250 years old. Yeah, well, this is California. The only thing that's 250 years old or more in this state is the freaking mountains. So that's kind of the way it is, right? But the architecture, I love it. I mean, there's so many different aspects to it. You learn a lot about interesting history. And I'm not going to bore you. I apologize. But anyway, so I find myself being pulled into that stuff for dumb reasons. Now, does that mean I shouldn't do that because it gives me pleasure? No, I should do it. But the smart move would be to do the more efficient stuff first. Once I've got a nice, steady, reliable income coming from my multifamily units that are out there just satisfying the needs of folks who just want a place to live, well, then I can become little philanthropist guy and go and restore awesome old architecture in homes and bottom line, be able to do it better than if I'm trying to build my investment strategy on the backs of those kinds of properties. So anyway, there's my I have a weak point in investing moment, I guess, where I'll admit it. All right, folks, I hope that's been some valuable information. I'm looking forward to Father's Day this weekend. I'm going to go visit with Dad, and you never know what to give your dad at some point. At some point, they don't want any more stuff in their house, so it becomes things like gift cards, or I think the latest thing is giving him cards that get him into the movie theater, right, with mom, so they can go off and have a good time. So I still have yet to figure out what I'm going to do on that score. I hope you all figured it out or have figured it out already and are ready to have a good time with Dad or whoever it is you choose to celebrate Father's Day with. Thanks for listening, folks. I hope you have a great weekend, and I'll talk to y'all next time.